Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Maddie Radner, Director on Nasdaq's Market Intelligence Desk, as well as Ben Hoff with SocGen. He is the Global Head of Commodities Strategy. We'll also be bringing in remotely Joyce, our Managing Director on Nasdaq's Market Intelligence Desk, for a look at the charts. It's great to have everyone with us. Welcome back to Trade Talks. Let's think about the impact of commodities in, let's call it medium term, first 100 days. It feels as if there's this rush to make a call when we have to separate the fact there's execution and then there's talking points.
Exactly, Jill. Yeah. Thanks, first of all, for having me back. Look, I think the short-term focus is very much turned to tariffs. Mm-hmm. We heard it yesterday from the new president. And I think this is something that commodity markets right now are really digesting. It has all kinds of complicated cross-interactions. In energy space, the US sees on the order of 3.7 million barrels per day of crude flows from Canada. In copper, it has all kinds of implications. We're seeing geographical spreads move around with the potential implications of tariffs. And we're actually seeing the same in gold markets as well. So lots of focus on tariffs. In the medium to longer term, the underlying questions are really policy questions. And the truth here, Jill, is that we just do not know enough about what is going to unfold. This presidential term is just too young to be making calls on specific policies.
It's literally like 24 hours. And when you look at it, whether it's financial media or media in general, trying to extrapolate from talking points what that policy framework might look like. However, Maddie, we can extrapolate some things from Trump 1.0 in terms of tariffs and how he's thinking about deregulation and tax cuts. There is a little bit of insight into that and the impact that it did play for 4 or 5 years ago, right?
Yep. So I think it will most positively impact the smaller cap names that we have listed here in the U.S. We saw them rally following the election outcome. And they're continuing to take off, especially as some of the pricing policies are coming into play. I mean, last week we did see the best week for stocks since November. We had a cooler CPI reading come in. We saw 10-year yields recede a little bit. And the thing about last week's rally, it was more broad-based than what we've been used to. It wasn't just led by a few larger cap stocks. We did see the Russell up a little under 4%. About 76% of the names were up last week, and obviously the larger cap stocks did gain about 3%, and 88% of the S&P was up. But I think it's worth noting that we're seeing more of a broad-based rally.
Yeah. Let's bring in Brian to the conversation for a moment here. And Brian, if you can give us a little bit of a longer-term chart on what you're seeing with the Russell 2000, because that index has kind of been, all right, ready, set, go, and then there's no follow-through with it.
Yeah, I mean, the Russell 2000, it's been very, very sensitive to what's been going on with rates and rate expectations. When economic data slowed down in July, we saw the Russell actually have a very good month. In November, things kind of changed a little bit where we didn't see the pullback in rates in November. They kind of held steady following the election, but the small caps did take off. A large part of that was maybe due to what was going on within the community and regional banks, which are probably most sensitive amongst the industries out there to the optimism around regulation. We did see last week the Russell 2000 bottom at its 200-day moving average. We tested that level back in the first week of August when we saw some broad-based selling. So after what was a pretty solid year in 2024, at least through the first 11 months, in December into early January, we did see some pretty wide corrective price action amongst most sectors out there, maybe with the exception of the large cap, mega cap growth stocks, at least for the month of December. So we've seen a nice rebound here, and small caps, just especially the last couple of days, are rallying higher. We are seeing a little bit of a pullback in rates just in the last couple of days here. We're looking at the 10-year Treasury yield here, where it peaked last week and is now pulling back. So I think that's maybe providing a little bit of a tailwind to the small caps as well in the very near term.
Yeah, and Brian, if you take a look at that chart, even through my remedial knowledge of understanding technical analysis, that looks like a nice setup on the Russell 2000 chart that you just showed us before.
Yeah, well, we're back above this level that was a high in July. So in the month of July, the Russell had a phenomenal year. The Russell 2000 financials was the best monthly had a phenomenal month. For the 2000 financials, it was the best monthly performance in the history of the index, and 57% of that is weighted towards community banks. But in general, we have seen a high correlation to where the market expects the Fed to go with its rate cutting cycle, and because we've been pulling back over the last 4 to 6 weeks, we've also seen the Fed have that hawkish pivot. They were expecting 4 rate cuts in 2025. In December, they signaled just 2 rate cuts in all of 2025. And then the economic data, the market was really then beginning to price just 1 rate cut in all of 2025. That's beginning to reverse a little bit after last week's inflation data. But we are back above that level for the Russell, which I'd say 2280, give or take, was a high for 3 months or so from July into October. When we got through it after the election and had a retest, it did successfully hold the retest. We gave that back here on the 18th. That was the day of the FOMC. And just today, we're getting back above it for the first time. I still don't think we're out of the woods yet, as far as, we're still below the 50-day moving average. It's not the end all be all, but, there is, as Benjamin noted earlier, such a great deal of uncertainty as to what the administration is going to do, the timing of these tariffs. So it's hard to say we're out of the woods yet for the setup.
Ben, what's so interesting is it's almost nice to take a break from all of the Fed talk. I almost forgot that it existed this week. But let's think about tariffs that we saw last time, December 2018, when the trade war with China really did heat up. It increases prices for those metals, but then your domestic producers, it's less competition, right? So it's you either face higher costs, or if you're a producer, it's more beneficial. So I guess we have to parse out that catch-22 again.
Yeah, Jill, I think you really are highlighting the crux of the matter when it comes to tariffs. So one thing that I will say, when it comes to tariffs and commodities, the crucial question is, where in the supply chain are they attached? The higher up in the supply chain, the further the downstream effects, the more like using a sledgehammer to crack a nut it's likely to be. The further downstream you go, when we think about specific finished products, the more the specific effect is going to be felt. So that's just something to bear in mind. This is why, from our perspective, when we look at copper markets, when we look at gold markets, gold is pricing roughly a 40% chance of 25% tariffs imposed with foreign trading partners. Copper markets are pricing roughly 30% chance. Those numbers seem extremely high, just because in the end, the aim of this is not to use a sledgehammer to crack a nut, but to really have a specific tariff effect as possible. And commodities are just a very complicated vehicle to achieve that with.
Speaking of complications, can you give us an example of what upstream and downstream would look like? Let's use copper as
Yeah, absolutely. So upstream means you are tariffing the finished refined product, the copper that comes out of a refinery and gets processed into an end product. So the effect of tariffs is that every product that is built along the copper supply chain ends up being affected. Downstream means you are targeting a specific end product, a car that might be assembled outside the US, a stereo system, you name it. These are end products, and the effect of tariffing those is very different and much more specific than an upstream tariff implementation at the level of refined copper exiting a refinery.
So if it's upstream, let's say, for example, the cost of building a home would be more expensive because copper is utilized in many areas of the structure.
Yes.
Got it. So let's think about your small caps for a moment here, Maddie. I mean, we've spoken about this all the time. They are so vulnerable and sensitive to any price change, any change in Fed policy. I mean, the delta with these is quite high.
Yeah, they're not going to be as flexible as some of the large cap counterparts with suppliers and with the fluctuations in commodities that we do see. So their profit margins might get a little bit squeezed depending on what commodities will be impacted in the future. I was looking today, we have Smithfield Foods on file to list in the near term, and they had a whole section on how the fluctuations in commodity prices will really change their bottom line and change their earnings quarter to quarter. So that was just kind of an interesting point that was
in the filing is one of the risks, right?
Yep.
Well, I mean, you could extrapolate that and think of other companies within that space.
Oh yeah.
Where it's, to Ben's point, when it's more upstream, It's not specific to one product or one company. Let's bring Brian back in here for a moment. Brian, let's pull up a chart of copper. Give us from a technical perspective what you're seeing, what that could indicate.
Certainly, Jill. So right here, we're looking at a weekly period chart, and it's just showing how the longer term, picture here. It's there was a phenomenal move higher off when we came out of the COVID crisis ever lows from Q1 2020. Generic copper peaked around 490 in mid 21. We tested that early 22, and we didn't see that again until the middle of last year. We got up to about 510. We did have that false breakout, as technicians would call it. And we pulled back to support down at 395. It's really kind of just been some sideways, sideways choppy price action since then. So really nothing that I would say from a momentum point of view that suggests to me or gives me great confidence in trying to anticipate where it can go from here. We're hovering around that 40-week moving average right now, so maybe that's acting as short-term resistance right now. But I think the bigger picture is just some really large sideways price action.
Right, and Ben, but that's indicative of Trump 1.0. I mean, even if you look at the overall market, the S&P 500, I mean, would you have like 4 or 5 handle moves every day? And then December 2018, when these trade wars started to heat up, that's when the fireworks took off. So it really is, anyone's guess in terms of how this policy is executed. But another thing you have to remember too, this administration really benches itself on market and economic performance. So there is, that subtle balance of not increasing prices too much, but then also maintaining leadership.
Exactly, and I think this is something that's particularly pertinent and relevant when it comes to energy. Mm-hmm. So I spoke about this briefly earlier on. The US largest importer of Canadian crude. Simultaneously, the US exports a lot of crude to Canada. The imports are all pipeline bound. They're relatively heavy grades of crude, which US refiners, particularly in the Midwest, are optimized to run as feedstock. So you suddenly come with a tariff hammer that breaks an entire supply chain, and ultimately no one benefits. The only one who pays the price is ultimately the US consumer. In the end, the consumer does not buy crude oil. He or she buys refined product and needs those refiners to be able to produce in volume the product that is desired. So perturbing those dynamics by imposing tariffs, the effect of that is very unclear. It's unclear who ultimately really pays the cost, to what extent it'll be Canadian producers, to what extent it will be US refiners, and ultimately it will be the US consumer who will suffer. So completely with you, that's something that this administration, like any administration, is very likely to want to avoid to the largest possible extent.
Well, I mean, the thing is, if we are importing heavy crude, unrefined crude from Canada, and we're exporting the refined product, you don't want to cut your nose off to spite your face, because if it's more expensive, you're not going to import it, and then if there's nothing to export, you're not making any money either.
Exactly.
Right.
Exactly right. And so this is where it's just difficult as a commodity specialist to look at the world and say, well, we're just going to have tariffs affect the supply chain at source, and this is effectively going to be in the US's best interest. It's in all likelihood not. If anything, our view on this, much more likely that we'll see some form of way more targeted tariff implementation, and that possibly this is just part of going to become part of a larger conversation.
Yeah. Let's remove tariffs and the Trump administration for a moment. Are there any other areas in geopolitics that you think are really impacting certain spaces within the commodity complex?
100%. And again, I think energy is really the place to look. We've spent a fair bit of time writing about this, thinking about this. One very large area from our perspective where there will likely be changes is sanctions imposition versus Iran. We see on the order of 500 to 700,000 barrels of Iranian export barrels potentially at risk as the US under the new administration steps up implementation of sanctions on Iran. That's one big focus. And then the other big question is really, how is OPEC going to implement its desire to bring back its additional voluntary cuts, to roll those back? So bear in mind, OPEC is sitting on 2.2 million barrels of crude that they've voluntarily removed from the market in an attempt to tighten the market. They've been very successful at this, but every day that goes by, is a day that those barrels aren't being sold, and that costs OPEC money. So there's a desire to bring those barrels back. The question is over what time frame and in what size are those barrels going to be brought back?
It's like playing 4D chess the whole time. It really is. And then, you know, Maddie, from small cap or, you know, any cap perspective, trying to be able to figure out, you know, your operating strategy, right, makes it challenging.
Yeah, the companies that have stable cash flows, efficient operations, and kind of can navigate these different headwinds and supplier costs will really be the most attractive companies moving forward.
Yeah, and Ben, to wrap up here, best case scenario, kind of business as is, or, you know, is there any strategy that could stabilize this in a better way versus trying to, you know, place conjecture on tariffs?
Oh, I think the best answer, as always, when you're facing uncertainty, is diversify.
Right.
There are a lot of interesting counter trends to be played here. Gold, from our perspective, we're relatively bullish. We see gold ending the year around about 2,900. Crude, we're relatively bearish. We see crude Brent ending the year around $70. That's still well below where we are today. And copper, look, copper is a much longer term story. There's even a time cycle diversification aspect here where medium term, the world needs the copper beyond what it has currently. So we are relatively bullish copper. We view copper going out at 11,000 2025 with potentially more room to run beyond that.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Market